I welcome you to this unit standard, and we are talking about knowledge and understanding of the fundamental principles of risk in finance in order to propose an insurance solution. And this is unit standard 242562. Let's jump right ahead. Let's talk about your understanding. Our outcomes are going to be explain the concept of risk transfer as opposed to insurance, explain the limits of insurance and the risk retention, risk transfer parameters, explain the different facilities involved in risk transfer, and propose an insurance solution to transfer risk in a business entity. So let's talk about what you understand as insurance. I think most of us have their own kind of an idea of what insurance is. But let's understand it from a business perspective and how it makes sense, and it makes business sense for companies to insure themselves and for other companies to take the risk of insuring others. There's an insurance company that is somewhere else there that is taking premiums, insuring other companies out of any risk that they may be facing. So what drives insurance is these risk transactions of being covered by an entity or an individual that needs the cover. So let's look at this image, for instance, this funny image of mine where people are tossing that looks like a bomb from one person to another. And this person is definitely willing to actually take this bomb on behalf of everyone else. And that's the concept of risk, and that's the concept of risk transfer and insurance. So if we may go through our theory, the transfer of risk is the underlying principle behind insurance transactions. So if this were to explode, these guys say, we want to be, this explosion would be out of our hands, but we'll definitely make sure that this person is compensated for taking the risk that we are not willing to take with this explosion in our hands. So what this means is that these people actually probably need, this in their hands because it benefits them in some way or another, but they just don't want the explosion and the consequences that come with it. So let's make an example of a car, that you actually need a car, but you don't want the expense of getting into an accident. Should that risk happen, you want it to pass it to someone else. Let's go to our second point that says the purpose of this action is to take a specific risk which is detailed in an insurance contract, because there needs to be an insurance contract that is binding the two parties and will detail on when does an insurer pay the insured at which circumstances. So you are just not covered for everything, but there will be details there at what point does the person actually get insured. I mean, for instance, if a person is found to have been drunk when they were driving a car and got into an accident, the insurance company is definitely not going to pay, because they will say that was under negligence. So those are the dynamics around an insurance contract. But the basic principle is there's a transfer of risk from one party to another who is willing to take the risk for a certain compensation, which can be in the form of a premium. So there's more methods of risk transfer besides your traditional insurance. For instance, the judicial one, if you are taking someone to court, to cover the losses that you have suffered, for instance, that will be a form of, a risk transfer, that you've now transferred this risk of a potential loss from yourself to the person who's actually caused the damage, to make sure that you are covered. For instance, now there's these companies that would say you pay a premium, and should you get into a legal battle with your employer, with your landlord, we'll make sure that you are covered. So in such cases, you are able to recover whatever loss that you have had suffered through the judicial system. But this is not guaranteed, so it cannot be directly compared to insurance. That is, if you win a case, then you would have been able to recover the loss. Nonetheless, this is a method of transferring whatever risk that you could have suffered or whatever loss that you could have suffered had you not gone through the judicial system. And another one is the contractual one. And a big example here is the indemnity. You understand indemnity, you probably signed some form that says, when you get into this building, for instance, you've gone to a theme park and they say, you are riding all these that are here, at your own risk. You are taking the risk. So if something happened to you, you would have taken all the risk, and we are not responsible for your life. So, for instance, if you park somewhere, there will be something would have been written there that says you are parking at your own risk. So that is some kind of a contractual, transfer of risk. But this cannot be, it cannot be applicable everywhere. For instance, if you get into a mall, it cannot be that the mall says, if a building collapses on top of you, we are not responsible for your life, because they are responsible for the construction of the building, the architecture, everything that has been planned, and the safety should the building burn down, for instance, to make sure that there's safe evacuation of that building, all those things. So there is a limitation in terms of this indemnity as well. But the example is perfect to say you can use a contract to actually move or transfer the risk from one party to another. So let's look at the purpose of applying principles, risk transfer at every level, right? So first one is identifying and evaluating risks. These principles are actually common at each and every level. It doesn't matter at which corporate level, business level, individual level. First, you identify the risk and the extent of the risk. So you're evaluating that risk. Some other complicated organization structures have sophisticated tools that they use to actually measure risk. So they will use probability theories. For instance, I will talk about the probability theories a little later, to determine, what are the chances of such a thing happening? And if they are able to practically and scientifically measure that risk, then they'll be able to say, okay, this risk is worth covering through insurance or whatever that they can actually put in place to mitigate or to lower that risk. Number two, avoiding or eliminating them where practical. That is the number two, where practical, how can we eliminate that risk? Number three, minimizing, controlling, or contractually transferring them when possible. So that is the three-step process that any organization, any individual, if you are smart about managing risk, you should actually take. Let's go a little deeper about this. So for instance, when practical, retain risk that can be self-insured. So self-insured means you've got probably your own funds. Let's say, for instance, cell phones insurance is not as big as it used to be before. I don't know which part of the world are you, but the theft of cell phones is not as rife as it used to be. I mean, you used to walk on the street and people would come and snatch a cell phone. So most people don't see the need of insuring a cell phone. So which means, even if they have not planned it, but they are basically saying, if this phone were to be lost, I would then have to replace it from my own pocket. So that's self-insurance, because you've measured somehow, sometimes not intentionally, but you've just measured that I don't need a insurance that I'm going to pay, let's say 50 rands or 70 rands or 100 rands per month to cover this phone, which is worth 3,000. I can save up maybe, let's say, for 3 months and be able to buy a new phone. It's too much trouble. Okay. So that is what organizations would actually do as well. And then on the second one, it's purchase insurance coverage when the risk is catastrophic in nature or beyond the capacity of the organization to absorb from current funds. So if the current funds we have, are not sufficient, to say that they can actually cover whatever risk that we are facing, the consequences would be catastrophic to an extent that we'll have to close shop. For instance, that would be something that you consider that, we would probably consider taking risk, insurance in this particular manner. It means transferring the risk to someone else. And when the purchase of insurance is permitted by law for a state, agency or whatever, so that if it is permitted or it is required that, for instance, that organizations take insurance, for instance, on behalf of certain employees that work certain kind of risk jobs or that are exposed to risk, then the company has to definitely take some kind of insurance for that. And then the second one says the expenditure of premiums is justified by services incidental to the insurance contract or the expected benefits. So if you realize that, the premiums actually justify, the benefits of then you will definitely consider and say, I am actually paying, let's say 500 rands and, the potential risk is worth over $1 million. And, should that risk happen, I will never have a million. So it's justifiable for me to actually, or for a company to actually take, that particular insurance. Then the third one is required by law or contract to have that kind of insurance. Then you are obliged. There is no way that you can actually run from it. So those would be the instances that a company or an individual actually considers buying an insurance. So let's look at transferring of responsibility to pay for losses. The transfer of responsibility to pay for losses may be undertaken either by insurance or via special clauses placed in contracts of sale, purchase, or employment, rent, etc. And then the clauses excluding one party to the contract from responsibility for any losses arising in connection with that contract, no matter how costs are known as exclusion or indemnity clauses. So those are indemnity clauses which you've already spoken about at length, that you enter into a contract and it's protecting one party and says, this party, should this happen, these particular circumstances happen, it's not going to take responsibility, and the other party that is actually suffering damage will actually have to cover themselves. So let's look at, the disadvantage, the different advantages versus different disadvantages of insurance. Advantages are that the insured can transfer risk for unexpected larger than expected or frequent losses to the insurer. The insured can substitute a known cost, a known future cost for an unknown cost, the losses. So the known cost is that you're going to pay a set premium of so much for the rest of the year. So that is a known cost for an unknown cost. So for instance, if you are going to be paying, it's 1,000 rand for car insurance, it's a known cost. For a potential loss that is not known, that you might get into an accident, the accident might cost 5,000, the accident might cost 50,000, it depends on that extent. So you are replacing the unknown, the uncertainty, because the more uncertain, the higher the risk. So you are replacing that uncertainty with certainty in terms of the premiums that you're actually contributing. In any one financial period, premiums paid will only present a very small proportion of values exposed to the risk or loss. Again, this benefit, if you are paying through the year, and let's say you've paid 12,000 because you're paying 1,000 rand per month, you'd find that those premiums would not even come close to the potential cover that you would have need should you get into an accident. Insurance acts smooth out the payment of losses over time. So even if, over the lifetime of this insurance that you've taken, you've paid up, the equivalent of what you are going to be covered for. But first of all, the insurance company helped you to save towards that, because you probably wouldn't be putting away money. But the second one is that it has smoothed out the potential losses. Because if you were, let's say, for instance, in 10 years' time, you can save about 100,000. But now there is no 100,000. So if a loss that is worth 100,000 can happen now, the damage would be felt because there is no cash flow that is actually available. So, it is that it's smoothing out those potential losses to make sure that you are almost cushioned, towards any significant damages that might cause, that might shake, for instance, your business or your personal life. In addition to the risk transfer mechanism, the insured also benefits from the insurer's subsidiary functions, specialist advice on claims handling, risk reduction, and so forth. All the administration that happens behind. That is, for instance, if there's a third-party insurance where the insurance company has to chase after someone who has to pay your insurance. If you get into a car accident, your insurance is going to cover you, but it will chase the other insurance company of the person who, let's say, bumped you in a car. You would, in normal circumstances, you would have to chase after those things, but the insurance company would do that on your behalf. So that's another benefit of having insurance. Disadvantage, not all risks are insurable, in particular speculative risk, so not all kind of insurances are insurable. If there's a speculative risk, is that it's known that it's going to be a profit or a loss. The intention of insurance, it's not to cause to profit someone, is to bring them into the position that they were in before. It's not to make the person money, but is to bring them into a place of balance before the actual loss had happened. That's the intention of insurance. So if there's speculative risk, speculation means that getting into this transaction, for instance, if you invest in the JSE, that it could either be a loss or a profit. So there's no insurance that would say, if it's a loss, then we are insuring you for that loss, because you went in knowing that there's speculation that I might lose or I might win. Okay, so that kind of insurance is not insurable, or that kind of risk is not insurable. Insurance really provide a full compensation for losses. For example, no compensation is paid for use of management time or loss of goodwill. So the insurance is not, there's things that can be quantified, in terms of what can be insured, and other things cannot really be quantified. For instance, goodwill. How do you insure goodwill? Goodwill is that soft thing, that brand of a company. It's not very easy to actually say the loss of brand or the loss of a reputation can be insured. That you can sue someone, through a litigation process for damaging your reputation, but you cannot say that I'm going to put a insurance should I lose my reputation. So those are some of the things, but it's real, is that there's potential losses in losing your reputation or integrity. Maybe there's a smear campaign against a certain company. It's very hard to actually manage such things. The other disadvantages is not all premiums are certain in timing and amount, and they may vary widely from year to year. So as the insurance companies increase their premiums, you might never know how much are they going to increase them for, as their perception of risk, as circumstances change, because there's factors that contribute to the risk, then they might actually increase premiums in that way. So that is the disadvantage of it, is that we cannot plan for a very long time, especially when, there's big companies that are paying big premiums to reinsurers, or to insurance companies. I mean, you find companies that are paying 50,000, 60,000 for an insurance of particular things, items, in their possession. So if that increases by, let's say 10%, it's a significant amount of money. In the very long run, the insured will pay more in premiums than he receives in claims. So this is just an example of how the insurance system actually works. Over time, you probably pay more than what you actually claim back, because you're not going to, probability theory says you're not going to get into an accident each and every year. So there will be those years that the insurance company benefits out of you not getting into an accident. So over time, those premiums would actually be maybe even more than what you've actually claimed back. So that's just the disadvantage of it. Quite easy. I hope you understand. Okay, let's look at the limits of insurance and the risk retention and risk transfer parameters. Let's look at the probability theories. It's a very interesting concept. Aggregate annual losses using a probability theory. So let's look at this cycle, for instance. This is a first example. let's look at this cycle. So this cycle has a couple of colors. If I may ask you, what are the chances if we were to spin this, right? Spin this cycle and it has to point into one color. What are the chances that it will point at either color, either red, purple, or blue, or yellow, or green? What are the chances? You know, if you understand the concept of, probability theories, you know that there's 1 in 8 chances that it will land in either color. There's 1 in 8 chances that it will land in either color. Because why? There's actually 8 colors here and it can land in one of them at a time. You know, so if there's an arrow, it lands on one of them at the time. That's probability theory. So the more the quantity, the higher the chances that it's actually going to happen. Let's go into the second example that will try and detail this. For instance, this is a bottle with marbles in them, right? There's a bottle in marbles in them. So how many are the marbles in here? It's about 34 marbles. So what are the chances that if I put my hand in it and I close my eyes that I'm going to pick a green marble? What are the chances? You know, what are the chances that I'm going to pick up the green marbles? So how many green marbles are there? There's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So there's 10 chances in 34 that I'm going to, pick up a green marble. That's what it actually probability theory actually means. That's actually what probability theory means. Out of all these marbles, there's 10 of them. Out of the 34, so I have 10 chances in 34 that I'm going to pick up a green marble. That's what a probability theory is. And we can use probability theories in any circumstances where we are able to measure what is the probability of certain circumstances. And that's how we come through our 3 principles into identifying a risk and evaluating. So here we've been able to evaluate, what is the extent, of this. I mean, let's look at the blue marbles. So in terms of blue marbles, there's 11 marbles here. In terms of red, so there's higher chances of me picking up a red marble because there's more of them in the 34. Okay, so there's 14 marbles in the 34, and then I can be able to say, no, there's higher chances of me picking up a red marble. So if I had to make a decision, and maybe let's say we win something if we pick up a marble, I will choose the red one because my chances of picking up a red one are much higher than picking up any other color. So followed by the blue one and the last one being the green one. Okay, so that's what probability theory actually means. Probability values may range from 0 to 1. If the value is 0, there is 0 probability that a particular investment will yield the estimated return. Yield, it means it will give a certain return if the probability is 0. If the probability is 1, then it means there is certainty that it will give this particular return. So your money market accounts, for instance, they give you, if they say they're going to give you 6%, they're going to give you 6% because there's less risk, there's less uncertainty. The probability is that you are going to get exactly 6%. But in the stock market, where it is very volatile and it's very risky, it's fluctuating, you don't know. So what are the chances? There's probability theories that are actually being used as well to see what are the chances based on certain circumstances, what are the chances that you'll get a certain return. And that's how decisions on investment are actually being made. So that was just the basis of it. Other risk concepts, the aggregate annual loss can be defined as the summated losses in rands for a specific financial year. So if you aggregate all those potential losses in terms of rand terms, that's how you actually get to an aggregate annual loss. Risk retention involves accepting the loss when it occurs. True self-insurance falls in this category. if you retain the risk instead of insuring. I made the example of a cell phone, for instance, but, companies can say older cars, we don't want to insure older cars, we'll insure the newer ones. The older ones we can easily replace from our own pockets. So that will be risk retention. They are retaining the risk should the car get stolen or whatever the case may be. Risk transfer, this is when then you actually get a company, you pay them premiums, you transfer the risks to them. So those are the concepts. Okay, reasons to retain some of the risk instead of transferring it all to an insurance company. High premiums. High premiums will definitely discourage a company, from taking an insurance. If the premiums are exceptionally high, it might consider, let's rather take the risk that should something happen, we'll see, we'll make a plan, we'll take credit or whatever the case may be. Small claims are expensive. So one benefit to transferring all risk to a company is to deal with all the small claims that come up during your normal business operations. The problem is that managing small claims can be expensive to the point where it may be better to just pay the claims, so that's another way that why the reasons to retain some of the risk instead of transferring it to an insurance. So you'd rather actually, if a company realizes that no, these claims, investigating and doing all those things is actually expensive, let's rather pay this particular claim. Small claims can increase your premiums. By letting your insurance company handle and pay for small claims, you risk having your premiums go up even more. So that would be the reason why sometimes you actually want to retain, these claims and say, I won't claim, because the more I claim, then the more the premium actually goes high. Even if you are insured for that particular issue, but you would rather retain, the risk. You already retain some risk. Even if you think you have full coverage, you really don't. You retain certain risk through having a deductible, for example, or by not purchasing coverage for natural catastrophes, for fire and whatever the case may be. The other things we say, no, we're actually retaining some kind of insurance or risk, because we cannot just insure everything. There's some things that you say the probability of this thing actually happening are very low. So I would rather not insure and contain some of the risk. So that those are some of the reasons why you would either retain some risk instead of transferring it all to an insurance company. For instance, the insurance company will give you options. Do you insure this? Do you insure this? Do you have a bond cover? Do you life cover? All these type of things, and you'll choose one and say, sometimes it's just a calculation in your head to say, I would rather take this kind of insurance, because this one, I don't see the likelihood of it happening. Okay. Risk retention activities can be executed in various ways. So by charging, to current operating costs, you might actually do the risk retention. So by paying losses out of your net profit, for instance, that could be a risk retention method. By selling other assets to replace other assets that are lost, that could be a risk retention method, that if something actually gets damaged, sell assets and make sure that we replace whatever that is lost. By building up a fund or pool near cash assets known as a contingency, should something happen, we have a reserve that is aside. That is another method of risk retention. By arranging loan facilities to be taken up in event of loss, I spoke about this as well. That could be another method of actually retaining risk. By forming a captive insurance company specifically to cover its parents' insurance. Sometimes this happens in huge companies that have to pay huge premiums, per month. They would rather set up an insurance company to cover everything, that has to do with. So it becomes two companies, that are benefiting from each other. But obviously, a significant amount of work in terms of analysis on whether this will be beneficial will have to be done. But there are companies. I mean, there's shipping companies, for instance, that transport goods that are worth hundreds of millions, and if they were to pay a premium, they realize we'd rather actually contain this and insure ourselves at a cost instead of at a profit when another company is actually insuring us. So those are some kind of examples that we would look at. The difference between provision and reserve. So let's look at the provision. Provision can be described as a present obligation which satisfies the rest of the definition of a liability, even if the amount of the obligation is to be estimated. So if you're making a provision for something, for instance, when we look at the accounting system, if something is provided for, it means there's chances that we are going to suffer this loss. So we'll actually put up a provision for it, you know, that for instance, we are going to have bad debts of so much. That is a provision. So what is called in accounting terms, provisional bad debts, you know. Whole call provision, for instance, a type of call provision on a bond allowing the borrower to pay off remaining debt early. The borrower has to make a lump sum payment derived from a formula based on the net present value of future coupon payments that will be paid because of the call. So if a call provision, it means the company, the issuer of the bond, and you need to understand how the bonds actually, the bonding system, it's a debt system, actually works. If you are borrowed a bond, there's a bond, you are a bond holder, right? But the company actually offers a certificate of a bond. Let's make an example. In fact, the perfect example is the government bond. If a government borrows money from the public, they issue a bond certificate that says this is a bond for 3 years. For 3 years, you're going to give us 30,000 and we are going to give you 10% interest each and every 6 months. Okay, not 10% each and every 6 months. Let's say 10% per annum, right? Which is the coupon rate, 10% per annum. You agree with the government, but the government might say, we have a call option. It means we can call back this bond. For instance, they realize that over these 3 years, they might have money that is coming in and they would not have to pay you back the interest over the 3 years. So that would have to then be calculated to say, if they were to exercise this call, which is in the contract, if they were to exercise this call, you know, how much would they have to pay you in terms of net present value calculated in the now? How much would they have to pay you to buy you out of the bond contract? It means they no longer owe you, they pay you a lump sum to buy you out of the contract. So you no longer hold that bond for 3 years and you're no longer getting the interest for 3 years, but it will only before the contract can be terminated within a year. So that's a call, that's what a call option actually means. So it's a provision. So the government would have made a provision of not losing over the interest that they are going to give you over this particular time. I hope it's audible, it's understood. Provision refers to the action taken to transfer risk, that is providing for potential loss by taking out insurance. So that's the form of provision. Reserve refers to actions taken to retain risk, that is providing for potential risk by creating a contingency fund. Okay. Alternative risk transfer, as we're closing this. So alternative risk transfer is anything that is outside of the common method of insuring any particular risk. If you retain that kind of risk, for instance, it means it's an alternative risk transfer. You know, if you are taking, for instance, indemnity, in terms of a contract, and say you're indemnifying yourself, alternative risk transfer, instead of taking insurance towards that. So there's different methods, measurements of making sure that you don't take insurance and instead you use other methods to combat whatever risk that you might be facing. We've come to the end of this unit standard. I hope you understood. Use all channels to help you to understand this content better.